Could a conflict involving Iran trigger a crash in the U.S. stock market? The geopolitical stakes are incredibly high, and the financial implications could be devastating. In today's video, we explore the potential mechanisms through which a major conflict with Iran could not only disrupt global stability, but specifically cause the U.S. stock market to plummet. Any conflict in the Middle East has far-reaching consequences. A war with Iran, given its size and strategic location, would be an event of global economic magnitude. The U.S. stock market is highly interconnected with the global economy. Its vulnerability stems from reliance on stable energy prices and geopolitical calm, both of which would be shattered by an Iran conflict. The single largest threat to the global economy from an Iran conflict is a devastating oil price shock. The mere threat of instability can send oil prices soaring. Iran holds significant sway over global oil supply, both through its own production and its geographical position relative to key transport routes. Disruptions here translate directly to price spikes. The Strait of Hormuz is a crucial choke point for 1/5 of the world's oil supply. Closure or severe disruption of this strait would cause oil prices to skyrocket, potentially leading to a global economic crisis and market crash. High oil prices fuel massive global inflation. This inflationary pressure, combined with economic slowdown from reduced spending power, forms stagflation, a toxic environment for stock valuations. War introduces profound uncertainty. Geopolitical risk aversion prompts investors to pull back from volatile assets like stocks, preferring safety over potential returns. In times of severe crisis, investors flee risky assets and rush into safe havens. This includes U.S. Treasury bonds and gold, driving capital out of the stock market and exacerbating the crash. A major conflict significantly erodes consumer and business confidence. Companies halt expansion, hiring stops, and consumer spending drops, leading to sharp declines in corporate earnings that fuel stock market pessimism. The VIX, often called the, quote, fear index, would skyrocket. This extreme volatility signals market panic, forcing leveraged investors to liquidate and further accelerating the crash. Beyond oil, a major war interrupts global trade and supply chains. This friction increases costs, delays production, and damages multinational company valuation. Global trade routes, particularly those passing near the Middle East, would face immediate threats. The resulting supply chain chaos would slow manufacturing and raise prices across all sectors, hitting stocks hard. A war requires immense military expenditure, leading to massive government debt accumulation. While defense stocks may rise, the overall macroeconomic burden drags down the broader market. While energy and defense sectors might see temporary boosts, the vast majority of the stock market, particularly consumer discretionary and technology sectors, would suffer severe, immediate losses. The combination of oil shocks, soaring inflation, and massive geopolitical uncertainty creates a perfect storm. It wouldn't just be a correction, it would be a crash driven by systemic risk. The crash mechanisms include oil price spikes, global inflation, a flight to safety, reduced confidence, and supply chain breakdowns. Each factor amplifies the others, creating a downward spiral. Understanding these risks is crucial for investors. While we hope for peace, preparing for the economic fallout from major geopolitical conflicts is an essential part of financial planning. If you found this analysis helpful, please like, share, and subscribe for more deep dives into global finance and economics.